Good afternoon, good morning, good evening, and welcome everyone from wherever you are joining us today to this webinar between Institutional Real Estate Incorporated and EPRA, the European Public Real Estate Association. Thank you for taking your time out of your busy schedules to join us today. We sincerely hope you find today's session valuable. I'm Marek Hansel, and I'm the editor of Institutional Real Estate Europe, and I will be moderating today's discussion. And with us today, we have Ana Escalante, who is the Property Equity Research Analyst at Morgan Stanley, and David Moreno is Indexes Manager at EPRA. Today's webinar will be primarily looking at European listed real estate market trends and corporate results from reports from 2023 to 2024. Some of the topics we aim to cover include the main trends in the corporate results that I just mentioned, the economic picture and its current influence on listed real estate and real estate investment generally, the recent performance of FTSE EPRA Nareit indexes, and perhaps some expected trends for the rest of the year. Before we start, I'd like to outline a few house rules for you. Those of you who are on the previous webinar may already know about these, but I'll just repeat them for those who are newcomers. There is a chat function where you can ask questions, so please do ask questions as we go along, and we will try and answer those either during the webinar at some point. I may ask the panelists the questions that come up, or try and get back to you. We can only get back to you if you actually identify yourself when you ask the question. If it's anonymous, then we won't be able to obviously find out who asked the question. We will be sending slides from this webinar to all attendees, so you'll get to see those that David is going to show us later on. And this is being recorded, so you can also listen back to this at your leisure. A link to the recording will be sent to you, and you can also share it with your colleagues if you wish. This webinar will last for 1 hour, and we'll finish on the dot to respect your time and your schedules. Okay. Yes. Hi, David. Hi, Anna. Great to see you today, joining us today. Thank you for being here.
Hey, Marek.
Thanks for having us.
Okay, so you're very welcome. Very welcome. So I think we're going to start perhaps with you, David, if we can. And we were hoping that perhaps you could kick us off with a summary of the recent performance of EPRA indexes, and maybe give us a bit of an overview of some of the notable comparisons across sectors and countries that you may have noticed.
Yes, absolutely. Thanks, Marek. Let me quickly share my slides. Okay, should be fine. Do you see them now?
We can see them. Yeah. Thank you.
All right. Okay, perfect, great. All right. So thank you, Marek, and everyone for attending this webinar. Let's quickly start with the overview of the performance on European listed real estate. So first, let's start by checking a regional comparison. So as you know, the FTSE EPRA Nareit index series is global and covers both developed and emerging countries. So here we have the recent performance of the main regional indexes as end of May. Here is evident the strong decline observed in all the regions between 2020 and 2022 as a result of the pandemic, of course. That's the largest chart you see on the left side of the screen. But also there was a short but strong recovery in 2021, and again negative performance in 2022, mainly as a result of the inflationary pressure derived from the Ukrainian-Russian conflict that forced many central banks to increase the interest rates, and that finished by affecting the performance of several financial markets, including listed real estate. However, in 2023, the picture looked much more positive for most of the regions, where developed Europe performed 17.4 during the year and outperformed all the other regions, including the global index. So this year, the regional indexes remained mostly stable. There was a slight short performance, negative performance in Q1 this year, but the starting quarter in Q2 was much more positive, especially under the expectations on possible interest rate cuts by the main central banks in the region. So basically, the performance this year has been pretty much stable so far. Most of the indexes remain flat year to date as end of May. But basically, there was a lot of investors expecting for some clear signals in terms of the national monetary policy in each of the countries in the region that actually materialized this quarter. So first of all, it was the Swiss National Bank that decreased the interest rates in March, followed by the Swedish Central Bank in May, and recently, just a few days ago, it was the European Central Bank who followed the trend. So actually, the main central banks in the region already start decreasing interest rates, and this was quite positive for the region. So in general speaking, as you can see, the returns on a regional basis, most of the regions still have a performance that it hasn't reached the pre-pandemic levels yet, except for North America. Most of the regional indexes still remain slightly below the pre-pandemic levels, and the recovery it's just in the process of coming, and it's the current trend right now. So let me quickly check a small comparison between the countries in Europe. So as I was mentioning, in Europe, we have the performance that was quite strong, especially in the second half of 2023. And again, a slight recovery during May and April this year, which implies that the one-year return was quite positive for most of the countries. And actually, looking at the difference across the countries, it was clear that the Nordics and the countries in the Eurozone showed the strongest results, both in the last 12 months and in May, especially in May, when many investors were expecting the interest rate cuts by the European Central Bank. So actually, in May, the European listed real estate outperformed also general equity and bonds. And this was quite similar to the trend we observed in the second half of the year in 2023. So this was much more evident in the Nordics and the Eurozone. However, the strong performance was not the same for the Swiss property companies. And basically, a couple of reasons for that. One of them is that usually the Swiss market is much more stable. So the negative returns observed in some other countries were not that evident in the Swiss market in previous quarters. And in addition to that, basically the Swiss market was less affected by the rising interest rates we saw. Of course, the interest rates were increasing as well, but the magnitude of the change and the inflation was also much moderated than the rest of the continent. So the other country that was a bit behind the performance observed for the continental index was the UK. And in this case, there was a certain level of uncertainty around the first interest rates cut by the Bank of England, which of course prevent the UK REITs to show strong returns during the first half of this year, mainly. But actually, it's going to be very interesting to see tomorrow, after the Bank of England's monetary policy meeting, their comments following the publication of the inflation report yesterday, where we saw that for the first time in almost 3 years, the inflation in the UK reached the level of 2%, basically coming aligned with the Bank of England's target, and basically giving some space for the central bank to start guiding on the way how eventually the interest rates cut will come in the coming months. So Now let's have a look at the sector's performance. So here we have the FTSE EPRA Nareit indexes by sectors in Europe. And again, basically what we can see here is the performance between 2020 and 2022, the pandemic period and the rising interest rate cycle. That of course it's pretty much the same picture that we saw before for the continent, but here is perhaps very interesting to see that the only sector that remained positive after the strong impact for these two shocks was self-storage, which has been proven to be one of the most resilient sectors in the European real estate industry. And actually, that's something interesting to discuss in a while. But basically, it has been a sector that has continuously providing positive returns and quite a significant expansion in the last few years. In addition to that, basically the recovery in 2023 was also quite good for some other sectors, residential leading the path. Also healthcare, industrial was very interesting, and healthcare was the only sector that show slightly negative results. But generally speaking, the recovery in 2023 was quite dynamic, quite strong for most of the sectors. And it was a good end of the year for the industry in the continent. And 2024 so far has been mainly positive for the retail sector, and that has been leading the performance for the industry, mainly in April and May. I think a big part of this result is related with the corporate results, and I'm sure Anna will comment on that in a while. But basically, the evolution of the retail sector has been very interesting this year. Of course, with some market deals and some interesting changes, and the other sectors basically have been quite stable as well. Again, industrial with slight positive performance similar to self-storage, and office and healthcare with slightly negative performance, but so far no big changes year to date as end of May. So again, as we can see, the performance is still below pre-pandemic levels for most of the sectors, except for self-storage and industrial that compared to the peak before the pandemic are already on the positive side. Okay, finally, I just want to conclude this overview on performance, making some small comments on the performance of the home builders and developers in Europe. This is not an index included in the FTSE EPRA Nareit index series, but it's an in-house developers research benchmark developed by EPRA, basically with the idea of tracking the performance of the home building industry in Europe that has been growing significantly during the last decade, especially out of the UK. The UK was always the traditional one for home building in Europe, but some other countries like France, Spain, Germany have been growing as well, and that's why we decided a couple of years ago to create this benchmark just for research purposes. And here what we can see is basically the performance. It's quite similar to the rest of the listed real estate industry. However, it's a bit more volatile, which is part of the characteristics of this industry, the home building activity that is a bit more pro-cyclical, a bit more volatile, the traditional leasing activities. But anyways, the performance has been always quite interesting during the last 4 or 5 years. You can see, of course, the same path during the pandemic, but 2021 was much more dynamic than the traditional real estate industry. And the increase in interest rates definitely affected much more severe the UK home builders than the ones in the Eurozone. You can see a big drop in the index that is not in the same magnitude for the UK, ex-UK version of this benchmark, but the recovery in 2023 was again quite strong, especially after September last year, and this year has continued. So in 1 year, the performance for the Developed Europe Research Benchmark for the developers, it's almost 35%, quite significant, and just last month was 10%. So actually, this industry has been growing, has been evolving as well in a very interesting way, and it's definitely a sector worth to keep in the radar for many investors that would like to have exposure to this industry. Okay, so I think that's already a good summary of the performance of the listed real estate industry in Europe this year and until 2023. So yeah, I'm happy to come back to you, Marek, and continue with the discussion.
Fantastic. Thank you, David. There's some very interesting insights there, I'm sure, for our for our viewers. Good to see there's a recovery happening in development as well. I just need to clarify one point, actually. The Q&A section is for questions, not the chat section. I've been told that I said to go into the chat section to ask questions, but that's not correct. You have to go into the Q&A section. So apologies to anybody who's gone to chat and hasn't been able to look at anything. Sorry, answer a question. Ask a question even. Okay, well, yeah, let's move on to the second question that I have for Anna and David, which is where you both stand on the current picture when it comes to property valuations. Obviously, David, you've mentioned the current interest rate levels in several European countries and the fact that we're waiting here in the UK for a decision this week as to where we're going to be going here. Are we all waiting for interest rates to fall a little further, or are we now in a position where we accept they're at this sort of stable level? They may move a little bit, and we just have to carry on investing within this new reality. And will that feed into more transparency in valuations, do you feel? Anna, what do you think? What's your take on that?
Sure, thank you very much. Well, I think that before answering this question, I should make a nuance because we have three different things in Europe. We have price, we have values, and we have valuations. And most of the times, these three things are not the same. Of course, we know where valuations are because we just need to look at companies' balance sheets to learn where the valuations are. But it is much more difficult to get information on where values are at the moment because we are not having any transactional evidence or very little so far. Last year, volumes in investment markets in Europe halved, and this year they have commenced super slow as well. For example, if you look at, German multifamily, you had a record low number of transactions in the first quarter of 2024. We are not seeing many transactions in the office space either. We are seeing a little bit more in shopping centers, but still, it is very difficult to say where values are because the only way to know where values are is with price discovery. And in general, we are not getting any. So in order to compare where valuations are with values, you need to think about where the company's balance sheet valuations stands versus where the reality is. In terms of how interest rates are affecting this, it is true that the lack of visibility in interest rates may be delaying some investment decisions, and that's why we are not seeing much transactions in the market. But for example, we asked the same question to investors last week in our annual property conference. And the most voted reason why investors and corporate as well thought we are not seeing enough transactions in the market is because valuations in companies' balance sheets remain too high for the new interest rate environment. So I think that the market is already pricing in that interest rates will fall from here. maybe there could be some, disagreements on when and where they will settle. But I think that what we should look at is, depending on what level we think they will settle eventually, how that will affect capital allocators' decisions. And by that I mean, pre-global financial crisis, if you look at commercial real estate lending in Europe, more than 90% of it was from the banks. That was banks lending. And after the global financial crisis and the implementation of Basel III in Europe, excluding the Nordics, of course, banks have reduced a lot this exposure, and they've been replaced by mainly insurers and other institutional investors. They were attracted to real estate because in the period of super low interest rates, they were not able to get their, let's say, 3.5% returns for the life insurance products in rates and credit. So they needed to go up a little bit further in the risk curve, and they turned into infrastructure and real estate. If we think that, for example, the German 10-year will settle at 2%, 1.8%, and credit spreads don't move lower from current levels, it's not a level that will force or that will make the real estate sector more attractive or attractive again to all these capital allocators that deflated a lot of capital into the sector during the last decade. I think that's the question we will have to answer. I'm not talking about distressed sellers, and I'm not talking about insurers materially reducing their current exposure to real estate. I'm just saying that if we move into an environment when rates and bond yields and corporate bond yields, BBB, will remain at levels not as high as today, but again, above levels we've seen in the QE environment, maybe the willingness to allocate capital to real estate won't be as strong as before. And that will definitely have an impact on values and most of all on valuations. I think that's it for me in terms of valuations in the direct markets. I don't know if you want me to comment as well on the impact on interest rates on the listed stocks, as David has already commented a little bit.
Well, it's funny you should ask that, Anna, because we've just had a question come in from Miguel Salas. Thank you for your question, Miguel, who's asked, how has the 25 basis point cut by the ECB impacted the real estate equity market? So there you go. That's almost the identical question, right?
Yes, exactly. So I think that when we look at how the European listed equity property stocks trade, we have to make a difference between how they correlate with the short end of the curve, the cut that this question comes about, and the long end of the curve. Going to the short end of the curve, if you look at how Eurozone stocks have historically behaved around a first cut, whether that first cut was the ECB or the Bundesbank before, they used to perform bad before the cut and very well after. But this time, it has been very different. This time, when we look at the Eurozone stocks, they have performed really well ahead of the cut. In a way, we think that means that they were anticipating that cut, and that index outperformed significantly and recovered to the year-end levels of 2023. Because as David said, we saw a very significant rally in the sector at the end of last year. Then when we moved into 2024, the sector gave more or less half of that away, but then rebounded again close to those year-end levels as we were approaching the interest rate cut. And since the cut, the sector has underperformed as opposed to what it used to happen before. But because we would argue that what has happened is that the stocks and the stock market was already discounting for that cut. Plus, we've had a lot of recent developments in Europe that may have affected the performance of real estate as well. But what I'd like to flag is that this time it looks like it's a bit different from what we've seen before, because the performance both before the cut and after the cut has been different to the historical average. Looking at the UK, for example, we are all of us waiting for the first cut. The house view of Morgan Stanley is that we get that in August. I think the market is implying around 2 cuts this year. And if we look at how UK stocks performed historically around rate cuts, that performance has been a little bit more mixed. There were some times that they outperformed before the cut, otherwise that they underperformed, other times they moved sideways. So it's much more difficult to gauge a very specific conclusion on that. When looking at where the sector is at the moment, the UK sector, and assuming that we get a first cut in August, we see that the performance is quite similar to what happened at the earliest 80s and 1980s. And that back then we saw that the stocks continued to outperform even after the first cut for a few days, or for at least the first quarter. But again, this is very difficult to draw statistically meaningful conclusions because the volatility and the standard deviation is quite high.
Excellent, thank you, Anna. Anything to add on that, David? Obviously, it makes things more difficult when there's a different reaction to a cut to historical reactions. That makes predicting stuff even harder, doesn't it? What's your take at EPRA there?
Absolutely. I think something that it was also very important is the efforts that this time the European Central Bank made for providing guidance before the interest rate cut happened itself. So actually, most of the analysts, investors were already expecting the interest rates cut that happened a few days ago, because basically the European Central Bank was giving a lot of guidance on this first interest rate cut, but right after the language was much more like it's going to be data driven. So basically, every time that you are going to have a discussion on monetary policy, you need to review the entire data set and see what's the new information, what is the change, because basically there is not a clear path. We are going to reach 3% in 6 months or in 1 year. It's always depending of the performance we have so far and the conclusion on the inflation and the growth at the moment. And the other central banks have been also quite active in providing guidance. I would say the only one that was quite a bit of surprise was the Swiss bank in March, that basically didn't provide that much guidance, just randomly at some point was completely unexpected decrease interest rate. But again, the language was the coming steps are going to be always data driven, depends of what is happening. And of course, the Swiss inflation has been less volatile, but again, it's a matter of providing guidance. So basically, what fully aligned with what Anna was saying, basically, the markets were anticipating the movement. There was a lot of guidance before the interest rate cuts were happening. Also, the Swedish bank was quite active on that side. But once the first interest rate cut happens, then there is a lot of uncertainty of how many additional interest rate cuts are going to come. And this time, the main expectation is around the Bank of England. But of course, the other banks are going to continue cutting interest rates, but smoothly. So basically, we need to see what's the language on the coming meetings, mentioning, okay, we see that there is quite strong evidence of stability in the inflation, that it's not the case so far yet. But if the central banks provide some kind of guidance on that side, we could say that at some point is going to be a clear path of lower interest rates for 2025. But until now, the coming steps are quite uncertain.
Excellent. Thank you, David. Okay. Just a reminder, everyone, if you do want to ask questions, then do put them in the Q&A chat function. We have a question here from Robert Lai. Thank you, Robert. To what extent does the geopolitical situation in Europe affect investment decisions? I think we will come to that, Robert. Thank you for that. I think we'll just park that question for now and just move into some of the main highlights from the corporate results from companies on the listed markets. That Anna can maybe give us a few highlights.
Sure, of course.
If you may, please, Anna.
Yes, sure. I'm happy to answer the question as well later. So in terms of corporate results, we had recently both year-end results in February and March, and then some year-end results from companies like the British ones who have year-end in March, plus some first quarter trading updates. I think that if I would have to resume that in one sentence, would be strong operational performance again. So when looking, for example, at the top line, like-for-like rental growth has been very strong all across the board. We've seen companies being able to pass inflation into contracts and into tenants, also to capture reversion in some sectors more than in others, and in other sectors a blend of both. But in general, I would say that the operational performance and the revenue resilience has been better than expected, because the consumer has proven much stronger than most of us were expecting. The economy is resilient, GDP growth is fine, and unemployment remains low. However, for some companies, particularly in continental Europe, this good like-for-like performance in the top line has been partially offset by disposals, because for many continentals, leverage remains a bit high or too high, depending on which sector we look at. And in order to deliver, a lot of companies are still in disposal mode, are net sellers, and some of the gains they're getting from the strong like-for-like, they are giving that away in terms of losses from asset disposals. When we move a little bit down into the P&L, we see that some companies have started to suffer from higher interest rates, because, as I'm sure you are aware, for real estate companies, the key cost line is the interest expense. And as interest rates go up, this rising cost of debt has started to bite the bottom line. However, admittedly, a lot of companies, especially in continental Europe, have termed the debt very well and don't have any upcoming maturities in the next couple of years, maybe except for the Swedish names. And as well, they hedge very well. So they have a lot of hedging derivatives in place that allows them to protect against these rising interest rates. So for the moment, we are not seeing a material impact of rising interest rates across the board in general, of course, with some exceptions. And all in all, that has resulted in very strong earnings performance, cash earnings, I mean. But when we look at valuations and NAVs, the story is a bit different. As I was saying before, we are still seeing a very material difference in continental Europe between valuations and values. For example, for one of the few sectors where we are seeing some transactional evidence, by that I mean continental European shopping centers, we've had 6 or 7 large shopping center transactions in Spain, France, and Italy at yields between 7 and 10%. But when we look at listed companies, we see that the assets are valued at yields normally below 6%. So we see a material difference there. When we look at the office companies, for example, we see most of them have assets, office assets valued at yields between 4 and 4.5%. Not only listed companies, but when we look at the open-ended funds, who are also one of the key owners of office real estate in Europe, they have also, on average, their office assets valued at sub 4% yields. And I think it's very arguably whether those assets are prime. But I'm sure that, as you know, in periods of where the real estate cycle is in the upturn, the concept of prime expands with the cycle. Anyway, or when we look at German residential, we see a lot of valuations below 3 or around 3%, which, it is difficult to say whether that's fair or not, because again, we are not having any transactions or very few transactions so far this year at those levels. And this is an issue. This is an issue for continental European companies because their leverage is elevated, not only the LTV, but also the ICR and the net debt to EBITDA. And coming back to our conference last week, when we were asking investors about what level of LTV, for example, they consider sustainable in the long term, they voted, or the majority voted for 35% or less. And when we look at where companies are at the moment, we see that in continental Europe, average LTVs are around mid-40s, and in the UK, they are below 35, so low 30s. And that's very important, particularly when we see that widespread between values and valuations. However, this is not the case for the UK. In the UK, we think that for most of the companies, NAVs have reached the trough, because on average, if you look at some direct indexes, you see that capital values have fallen by 30% now from June 2022 peaks, after a period of where nothing happened in the office sector, because yields and rents remained very stable in the last 7 years, and when retail had already suffered a lot. So in the UK, we saw valuations falling down materially, even if we didn't have a boom in the previous years, and leverage, reasonable levels of leverage, and companies with healthy balance sheets, healthy valuations, which we think will be able to benefit from the recovery of the cycle. What we are afraid that can happen in continental Europe is that even if the external appraisers don't write down valuations to where we are seeing values seem to be, during the time that values recover, valuations will just remain flat as yields revert to the historical average just by capitalizing rental growth, but without valuations growing. So we think that in the next few years, what we will likely see is some performance similar to what happened after the global financial crisis, where the UK companies, after suffering a lot, rebounded and profited from that recovery, but the continental European names didn't do much because they had to wait until values met into valuations.
Excellent.
I think I'm going to leave it there.
Yes, no, thank you, Anna. We've had another question which you may be able to answer straight off your previous answer. Obviously, you mentioned the ideal leverage situation, LTV situation, you said is 35% or less, and at the moment it's in the mid-40s. And we've had a question asking if takeovers are expected in the short term within the market, with some companies struggling. Are we expecting any takeovers, Anna? And perhaps, David, you could maybe chime in on this as well.
Yeah, I think David has some good charts on that, on historical equity and debt issuance in Europe. On my side, it's true that we have started to see some of that, particularly in the UK. We had some M&A approaches last year. We had seen another one this year. We have also seen a company trying to IPO to take a chance of the opportunistic acquisitions in the market. So it is very difficult to call on that. I think it will depend on the private appetite towards real estate. And historically, in the last 3-4 years, we've seen some take privates. I think that, again, that comes to what I was commenting before on the where the interest rates will settle and the willingness from the capital allocators to increase their exposure to real estate, and also where the opportunities settle, depending on those hurdle rates that some of these private funds are required to do or have internal, or their internal targets are, and what they think they can get in the listed markets. But it is true that M&A, for example, at least in the UK, it has increased versus a year ago. M&A approaches.
Yeah. David, any thoughts on takeovers from your side?
Yeah, absolutely. Definitely. Something that we have constantly been monitoring is the evolution of the bonds market and general debt profile for the listed real estate companies. Actually, that was one of the main topics for discussion back in 2022 and last year. And it is still one of the key points that basically, as Anna was mentioning, the companies, many companies have been quite active in managing their debt and managing the investment horizon, the debt horizon, the maturities, especially because when we were checking the performance of the entire industry, we were seeing that mostly around 40% of the total debt was going to mature between 2026 and 2028. So basically, these are the years with the largest composition of bonds maturing, and also a lot of bank loans that many investors were concerned how the companies were going to attend these maturities. Also, some of them in 2024 and 2025. But the good news is that the bond markets start stabilizing this year when the expectations on interest rates start changing. And actually, this year in real estate, we have seen almost in 5 months, almost the same amount of bonds issued in one entire year last year. So this year, the property companies have raised more than 9 billions in debt, and last year was 10.4. So basically, in 5 months, almost the same amount of one entire year. And basically, because the expectations on the interest rates and the evolution of the bonds market also have changed, and now, of course, it's a bit more expensive, but it's also more manageable for companies to roll over the debt. And we have seen a lot of activity in that front. Many companies already prepared the resources for the bonds maturing this year, and are already issuing bonds to cover the ones for next year. So actually, that's a very strong point. And in the M&A activity, basically, it makes a lot of sense for some companies when you have two small or medium cap companies of rating around triple B or triple B minus to merge, and once you have one larger company with more access to financial markets, eventually with operational synergies, portfolios matching, operational approaches quite similar, and debt profile also quite complementary. Actually, you can have a higher rating and lower debt cost. So at the end, how you manage the increasing interest rates, that's one way. Of course, larger companies are usually much more open to raise capital in the capital markets, in the debt market especially. That comes with some specific cost, but of course, in terms of the covers, that makes a lot of sense under the moment of the high interest rates where we are. And especially companies are getting used to the new interest rates environment. So we came from a very long period of very low interest rates, almost zero in many countries. And for sure, that's not going to be the case for the coming years. So eventually the companies are just getting used to the new environment, the new cycle, and the takeovers and M&A activity. It's especially one way to make companies larger and more resilient to this environment.
Excellent. Thanks, David. Okay, well, maybe we'll return to, before we move on to sectors, because I'm sure our listeners, viewers would like to hear your thoughts on some sectors, particularly after you sort of mentioned the stats on self-storage and industrial, David. Robert's asked, to what extent does the geopolitical situation in Europe affect investment decisions? Obviously, a lot going on in many spheres. And we know that equity markets obviously react negatively to bad news and good news very at the drop of a hat. But yeah, what do we think within the listed real estate market? It's what's the mood there when it comes to the geopolitical situation?
Sure. I mean, I think there is a very simple answer and a very simple way to look at this. Property is a capital-intense industry, so capital availability is a crucial driver for the performance, more than the cost of capital itself. So if you look at property markets are local, obviously, but the capital that invests in it is not local, it's very much global. So any erosion of confidence in Europe can affect, well, better deflect global flows away from the region, like it happened with the UK, for example, in the last decade. On top of that, we have already flagged that significant parts of the continental commercial property market face challenges. We see the substantial pressure to delever in large part of the continental sector. We witness a lot of companies with valuations that's book value significantly above where values, that means reality, is. And increasingly price discovery may lead to some pressures in some balance sheets. And we also have other structural pressures, for example, for offices working from home or the open-ended funds in France and Germany, as I have already hinted before. So all this increasing uncertainty around the political climate could reduce the likelihood that liquidity comes back into the market. And basically what could happen is that these low levels of transactions in the investment markets remain for longer. and it could slow down or delay a recovery in the real estate market, and therefore reduce the probability or the likelihood of these companies to deliver through asset disposals.
David, any thoughts on your side? Geopolitical situation?
Yeah, absolutely. I think something that also matters in this case is how the evolution of the speech around government spending is going to evolve, because that's going to affect some specific sectors. We're going to discuss in a while the healthcare, that is one of these sectors that is quite sensitive to government spending. But of course, the evolution of the recent changes in elections and regulations are quite important on that side. But also, it's important to have in mind that the property companies are quite dynamic, and they evolve and they adapt to the changes. And a good example is, for example, for instance, the modification on the Dutch grid regime that actually was creating a lot of uncertainty in the Netherlands and the property markets around. So that was what would be the impact. And actually, what has happened is that many of the companies have decided to adjust to the new regime, make some changes, a couple of mergers, trying to be useful in terms of the grid regime in other countries, in Belgium, in France, in Spain. Also, some companies moving into different markets and exploring different segments. So basically, it's true that the elections, regulatory changes, and other movements in the market that create uncertainty usually create a bit of noise, but most of this noise is temporary. If you see the short term, you see volatility, you see changes, you see markets dropping or evolving quite fast depending on the news. But when you look at the long term, that is usually the way how you look at real estate. These changes start disappearing when the uncertainty is removed, and this uncertainty usually doesn't go for very long-term periods. Usually it's few months or a couple of years max, but eventually that happens. So right now, I think what is very important is to see what's going to be the speech of most of the news coming in different countries regarding government spending, because that's also going to affect the debt for many countries. Many of the governments are quite in debt now, and the high level of fiscal deficit is going to increase the level of debt, and the level of debt is going to affect the debt markets, including the corporate bonds for real estate companies. So basically, this is a sequence of events happening that we should have a look, but also, as we were saying before, the companies are already adapting and adjusting their profile, their own balance sheet, their own operational metrics to be able to navigate these changes.
Yes, no, important points you both make there in relation to the geopolitical situation. Thank you. Yeah, you mentioned healthcare actually, David, there. We'll quickly move on to sectors. We have a question from Philippe Etienne, who's asked, what are your views on the healthcare real estate markets? When do you see a rebound of this segment? And I guess that's very much tied into government spending and debt levels and what have you, as you mentioned, David. Are you positive about the healthcare real estate market? Obviously, there's a demographic, a mega trend pushing it, but what about in the short to medium term?
Yes, absolutely. Actually, we have been paying a lot of attention of these alternative sectors, we call. Basically, what we mean by alternative sectors is healthcare, self-storage, senior, social, and student housing, and even data centers. And that's going to be for the end, because it's actually quite interesting, but not quite visible in Europe yet. But in terms of the evolution of these alternative sectors, basically we have seen that the sectors have been growing quite fast in the last decade. Some of the sectors, for instance, self-storage, have reached eventually some annual growth rates of even 16, 17% in few years. and it's becoming much more important than it used to be in the past, when basically real estate was mainly office, residential, retail, and industrial properties. So that was the universe kind of 10, 15 years ago. But now the alternative sector are becoming much more important. And one of the main reasons for that is that the drivers behind the evolution of these sectors are different. So these alternative sectors are actually quite interesting for diversification, in the sense that the economic drivers affecting each of these sectors are quite different. So at the global portfolio level, if you have different drivers that are affecting the sectors in different ways, at the end, the result is a lot of diversification. And of course, the healthcare is one of these sectors that has been pushed significantly because of the pandemic. The pandemic actually was quite good for the healthcare sector, in the sense that raised a lot of attention around a sector that no one was really following actively. And of course, there were some issues with some of the healthcare operators and so on. But the good thing is that, okay, once you get attention and you identify the issues in the market, the industry starts evolving, and the evolving and improving and growing. That's the main point here. So actually, the healthcare has been growing significantly. One of the main sectors, subsectors in the healthcare, it's actually senior housing and care homes. And there is a clear deficit of care homes around most of the countries in Europe. And it's almost everywhere where you go and look at, you see the aging population, you see many issues with the supply of new healthcare facilities, a lot of demand. The aging population is not only affecting the care homes demand, but also the demand for healthcare products that require healthcare facilities and real estate to be produced. Life science, for example, it's also a rising sector, calling a lot of attention right now in many different regions, and just starting in Europe, mainly in the UK so far, but it's growing as well. So yes, the question here is, how is the healthcare evolution, and the answer is it's good. It's good, but it's good not eventually in few years. This is a matter of long-term trends, and long-term trends related with demographics that also materialize quite slow. So this is a matter of changes that we have seen evolving in the market, but it's quite resilient. But of course, it's not a sector that grows on a very specific speed, like some other sectors that have been much more visual in the last few years. And I think the best example on this front is data centers. Unfortunately, we don't have yet any data centers specialist in Europe. The market is still dominated mainly by private real estate investors, or by some listed REITs that are non-European. So you have a lot of American REITs investing in Europe, and the European property companies have realized that there is a lot of potential in that sector, and there are already a few companies in Spain, in the UK, in France, investing in data centers, already taking the brave first step to go into a completely different business that has a lot of details in the operational, in the operations, the cooling system, the electricity, all the power generation, all the data connection, the networks are quite technical, are quite hard to face. Is not the common business of a real estate property company working on, but it's very important to look at this, because basically this is the moment when you see the first very few first steps going into a direction that is going to be quite large. And if we look at history, that was the case in the US already 10, 15 years ago. So the companies start growing much faster in the US with the expansion of the digital macro tech companies in the US, Apple, Microsoft, Nvidia, Google, all of these. But it's still growing in many different geographies. It's growing in Europe, and it's growing in real estate. So basically, we are paying a lot of attention to these alternative sectors. We are working on a report covering most of these sectors right now that is going to be released in a few weeks. But it's definitely something that it's calling a lot of attention. And basically, there is a lot of opportunities because we cannot allow just the American REITs to make profits on the European real estate.
Yes,
Yeah,
absolutely, David. No, go on, Anna. Yes.
I was just going to say that I pretty much agree with what David has said. I think it is material that we see EPRA and EPRA indices, the umbrella extending to all these alternative sectors, because that would be key in for the growth of the listed European property markets. In terms of healthcare, I think that what David said is right. We also think that the structural tailwinds we see in that particular segment, especially in the care homes, are there to stay. However, all the concerns around the operators and the operator sustainability in the last few years have dragged on the sector, because I think the perception was that this was a very inflation protected, or at least an inflation tracker. And now we've realized that with the operators struggling, maybe this is not the case. So I think that, to answer the question, until we don't get more comfort on the operator's future and sustainability in the medium term, we won't see a rebound or a recovery in the healthcare listed sector. On data centers, yes, I couldn't agree more. I think that the general view is that this is going to be driven in Europe more by private players than by public players. But we would definitely love to see more listed players investing in this particular space, because our perception is that it is one of the few sectors within real estate that still gets a lot of investor attention. So yes, looking to see more of that. Even if we acknowledge that there are a lot of limitations there, particularly power constraints, not only in terms of the generation, but also in terms of the transmission, the grid, the infrastructure. So there's needs of a lot of investment to go here in that space in Europe.
Yeah. Thank you, Anna. Yes. We do have one question, so asking for an approximate answer in relative terms. When it comes to the listed universe, how big are alternative sectors compared to the classic sectors? I suppose the problem with that is what do we call alternative these days? I mean, I suppose residential is not really alternative anymore at all, is it? Well, maybe some subsectors within it are, but do we have an answer on that at all, David or Anna? A sort of an approximate figure, how big they are in Europe?
Yes. So basically, so far, what we see is that if you aggregate these sectors, mainly student, social housing, care homes, self-storage, and even data centers, that represents around 10% of the industry right now. But basically, if you follow the trends on how this evolves in other geographies, especially in the US, that has grown into diversification and growth of these alternative sectors in the past. Basically, we're expecting these alternative sectors to become around 20 or 25% of the industry by 2034. So basically, during the next 10 years, you will see the growth of these sectors evolving and many companies investing and growing in that sector. So far, it's just a small part of the pie chart, but for sure it's going to be much larger in the coming years.
Excellent. Well, on that positive note, we've almost reached the end of the webinar. We're reaching the hour now. We do have two more questions, and we'll endeavour to get back to you both, to the gentleman who've asked the questions. I think you're gentlemen. Sorry if you're not. We'll try and get back to you after this webinar with some answers. But in the meantime, thank you both to you, Anna and David, and thank you to all our participants who've asked questions, and for all you viewers and listeners who've joined us today on the webinar. We hope to see you at the next one that we have in due course. Thank you, everyone.
Thank you very much.
Thank you.